Hello and welcome to a brand new series of Classroom. We are back walking you through all the basics that you should know and why they are so important in the art of both investing and being part of the capital market and the equity market. So to kick off proceedings today, we will start with the simplest element or building block that one can think of, which is what constitutes a balance sheet and what should you look at while analyzing a balance sheet. Of course, it's not the be-all and end-all in terms of documents to track, and there are many others which are equally important, if not more. But this is just the primary line to draw while understanding financial analysis. My two guests today, two men who understand that very, very well indeed, D.D. Rathi and S.P. Tulsian. Gentlemen, great to have both of you on the show. Mr. Rathi, just to get things in perspective for first things first, how would you go about defining a balance sheet?
Mithali, I would not be able to limit myself merely to balance sheet. I presume that when you say balance sheet, you possibly include key financial statements, at least like balance sheet, profit and loss account, cash flow, auditors' reports thereon, and notes on the accounts. So if you go to the constituents of financial statement, balance sheet is one of the key financial statement. Now to define the balance sheet in very few words is that it gives you the state of affairs of the company's assets and liabilities, including contingent liabilities, on a given date. Mostly in India, we talk of 31st March as a balance sheet date. So balance sheet would be aimed to define company's assets and liabilities, including the contingent liabilities, on the given date.
Mr. Tulsian, so statement of financial condition. What would you say is the key importance of a balance sheet? Why is so much stress put on analysis of balance sheet, either for year ending, as Mr. Rathi pointed out, or even on a quarterly basis?
See, in fact, we get to know all the, as Mr. Rathi has said, the assets and liability. But again, if I just go by the submissions having made by Mr. Rathi and focus on the entire annual report, in fact, at a relevant date of time, we get to know the capacity, we get to know the financial performance, the operational efficiencies, the ratios, like the profitability and all that, plus the assets, which can largely be available to the company for monetization. And apart from this, the sections which Mr. Rathi has defined, there are other two important sections, that is management's discussion and analysis and the report on corporate governance. Because both the things are very important, because if you just suppose for a time being, if I just omit or exclude the reference of director reports, all the references are given by the management in their MDA, that's management's discussion and analysis, which in fact gives the review of the year which has been, passed by, for which the accounts are all being presented, plus the future prospects or the outlook for the coming year.
I'll get to Mr. Rathi on the qualitative aspect of this, Mr. Tulsian, but broadly then the three verticals we're focusing on are assets, liabilities and equity. So how would you define these three headers?
See, again, because firstly the assets are all the properties which are owning by the company, and the liabilities, obviously the matching capital having brought in, to create those assets. Suppose if I say that my assets of 100 rupees have been created with equity, or the net worth of about 80 rupees with the debt of just 20 rupees, obviously this will be viewed very positive. And if I just say that it is conversely the other way, 20 rupees equity or the net worth with 80 rupees debts, obviously that sends the alarming signal. So overall, we get the picture on account of the fixed assets and net worth on one part. On the other hand, the current assets and current liabilities section. Similarly, if your current assets are largely financed by the current liabilities only, that obviously gives the bad picture again.